Quick video on cash budgets linked to A2 June 2020. Obviously, it's paper 2, question 15.1. Just to clarify, you are very likely to have a question on budgets. It's a common question on paper 2. Makes sense being focused primarily on management accounting. No gimme, but you could have a question on the sales budget, production budget, labor budget. Came up as a 4-marker last year. Purchases budget, and the budgeted financial statements. Be aware of how to prepare them, be aware of the benefits and limitations. 2 on each is usually what I would say. And the one that would be more marks is the cash budget. So the cash budget's got a little bit more going on, so you need to be able to prepare the cash budget and also understand the layout. So just to clarify the layout of the cash budget, you need to clearly show your inflows, your outflows. It doesn't need to be formatted in a certain way, just inflows, outflows. You then have your opening balance. So in this question, they should have told us the opening balance. You're then going to have to calculate your net cash flow. You need to label net cash flow and demonstrate you understand it. So net cash flow being the difference between the inflows and outflows. Then you add that to the opening balance and you have your closing balance. Make sure the bottom half has got those 3 clear labels. Lots of students lose marks by just putting the numbers or just forgetting that that part exists. So for this particular question, let's just look what the question's asking us first, because before we look at everything, that's what we should be focusing on. We're going to prepare a cash budget for the month of January, and it's worth 14 marks. It's only 1 month. Where, to be fair, we've got 9 items listed, so that makes sense as to why this is so many marks. This has come up as an 8 marker before. It could be less, but generally speaking, the cash budget's got enough complexity that could be a higher mark question. This does link to a 6-mark written question, and we'll briefly discuss how that could be approached and different ways in which they could ask that after we go through the mark scheme. We've got our sales and purchase figures for November, December, and January. Well, we'll talk about why we need all 3 of those in a moment. So we just go through line by line. Put these in your workings. In your workings, just go 1 through 9, how you've used them. Some of them you won't need to have a working, but the majority of them you need to have something. So let's break this down. So sales, the most important part with sales is when are we paid? A cash budget is how much money we actually have. So when is the money actually going in to our bank account? And so what they've said is 20% of sales are on a cash budget, a cash basis with a 3% cash discount. So cash basis, they're paid in the month of sale, they're paid instantly really, and we're going to get a 3%, or sorry, we're going to give a 3% discount for them doing that. So that means for January sales, we're going to receive 20% of it in January, but only 97% of that amount. So like I say, clearly demonstrate your workings to show the examiner that you've done this. So if any of the other bits you do wrong, you can still potentially gain a mark. 60% on a 1-month basis. So we've got credit, we're paid on a later date. And so what we're doing here, apologies, I need to have a little quick drink. What we're going to do here, 60% on a credit basis, so 60% of December's, because that was a month previous, and then 15% are on a 2-month credit basis. So that means we're going to be paid 2 months later. So that's why we've got November sales. So November sales will be paid, or 15%, sorry, of November sales will be paid in January. So for me, I'd go cash sales, credit sales, December, credit sales, November, and then add them all up. That's your inflows. Note 2, a provision for irrecoverable debts is calculated at 5% on all sales. So what we've got here, if you actually added those 3 up, it's 95%. We don't actually receive all of our sales. We think that some of them are going to be irrecoverable. That's a profit item, won't be listed in the cash budget. Bit of a red herring in some ways, but we're just going to ignore that for the purposes of this question, because we've already allocated what money we're going to receive. That just means we're not going to receive all of it. We're not going to record an irrecoverable debt as an expense because it's a cash budget. Item 3, half of purchases are on a cash basis. So 50% of January's purchase figures will be cash purchases in our outflows, and the other half are being on a 1-month credit basis. So we'll pay half of December's purchases in January. Nothing for November, that's already been paid. Wages were £6,000 in December and paid in the month incurred. All that means is we pay them straight away in that month, so no fiddling with month previous. But from January, they will be increased by 2.5%. So you're going to have to increase the 6,000 by 2.5% to gain that mark and include that in the outflows. A loan is currently being repaid in equal installments over 5 years. And so what we've got to work out is how much 1 month's installment would be. So 45,000 over 60 would give us our monthly installments, because obviously 5 years is 60 months. Interest is charged at a rate of 5% and is calculated and paid on the basis of the outstanding balance at the start of each month. The amount owing was £18,000. So we'll go for 5% of 18,000, but remember, it's only 1 month, so we'll do a 12th of that figure. Non-current assets have a cost of 60,000 and an estimated scrap value of 12,000. They are being depreciated at 20% per annum using the straight line method. Now we know, or hopefully you know, depreciation is a non-cash expense, so we will not list depreciation in this cash budget. They want you to do that. You're going to lose alien, sorry, that you're going to lose marks because that would be considered an alien item. But it's there for a reason, because if we look at number 7, expenses including depreciation are 15,000 per month and paid in the month incurred. So you've got to work out the depreciation on the non-current assets and take that away from the expenses figure. So we'll look at that in a moment. But obviously, we've got to remember the monthly part as well. Cash drawings are taken each month based on 8% of monthly sales, which is a simple calculation there. And here's our opening balance of £1,250. Okay, so we've talked through a little bit around what we do with the question. Let's have a look at what the answer looks like. If you want to give the question a go and then pause, and might be a shout, please do, and then we'll have a look. So this is what it should look like. So we've got our cash sales here of 11,640. You're going to get 2 marks for that, because if you forgot the 3% discount, you could still get a mark. So you get 11,640. It doesn't say this in the mark scheme, but primarily if it's not in the layout, you might not get full marks. But it does depend on the particular question sometimes. 1 month credit sales, £33,000, so 60% of the previous month. And then we've got 2 months credit sales, which are the ones for November, and that is 15% of November's. That gives you the 7,200. Then we've got our total receipts, or our total inflows, of 51,840. Cash payments, 18,000. Well, we said that was 50% of January's, and then we said 50% of December's. That gives you the 15,000. Wages, we're just going to add 2.5%, like we said, and there we go. There's that 2.5%. Bit of a weird scribbly line there, but that's not always the best with the highlighter on this. We then work out the monthly repayment. Like I said, 45,000 divided by 60 gives us our £750 repayment. We've then got to factor in that we've got the interest. So like we said, 5%, and a month of that is £75. See? Kicking along here. We've then got our depreciation. So if we look at it, we've got to work out the net book value first, clearly, because we had a scrap value. Sorry, net book value. We've got to work out the scrap value, take away the cost, if I could get my words out. So we feel that the asset's only going to be depreciated by 48,000 because we're going to gain 12,000 back at the end of its useful life. 20% of 48,000 is the annual depreciation. So we've got to be 9,600. We've got to divide it by 12 to give us our monthly depreciation of £800. You get a mark for doing that. You get another mark just for taking it away from the 15,000. That's quite a nice 2 marks, just remembering depreciation is a non-cash expense. We sold £60,000 worth of items in January, so it's 8% drawings on that, which is 4,800. Opening balance, they're not going to give you a mark, you're just putting that in, but you've got to remember it, because else the rest isn't going to work. Net cash flow, difference between the inflows and outflows was minus 7,135, and the closing balance minus 5,885. So those two are own figure. So as long as you don't have any alien items, you can gain those marks. So cash budget is a little bit awkward. You've got to remember the cash and credit items, but if you're methodical, this can be full marks, or as near as you can to full marks, which is obviously what you'd like. The 6th marker in this particular question was that the owner wanted to delay payments to suppliers to improve their cash flow position. What do you think of that? Now, that's a nice question, so you just delay it and say why delaying paying suppliers is a good thing. You'd use some figures from this to explain it. Obviously, if you delay them, that means you can keep on the cash for longer. However, you've got the problem is that you might upset your suppliers, and you may then lose out on loyalty. They may stop selling to you on credit, or you can also have another alternative. What else could they do? Could they get customers paying quicker? Could they have another source of finance? So the 6 markers, you've got to be balanced. You've got to have for and against the statement and make a judgment. Use some figures. So if it was a cash budget, use some figures from the cash budget. And it's primarily going to be how could you resolve a cash flow issue? What sources of finance? Or analyze their cash flow position. So it's not going to be too bad, but make sure you got balance, make sure you got evidence, and make sure you have a judgment. Good luck.